Finance runs on narratives. Analysts, investors, communicators, everyone tries to explain markets by identifying clear clauses. Why did the stock go up? Why did a bubble burst? Why is this fund manager outperforming? People want answers. By doing so, they fall into a consistent trap. They mistake coherent stories for truth. In the real world, especially in financial markets, it's noisy, complex, and full of randomness. But the human mind doesn't accept randomness easily. It craves order. So when something happens, the default instinct is to construct a cause, even if none exists, or if the cause is far weaker than it appears. This drive to explain leads to two dangerous illusions, the illusion of understanding and the illusion of validity. Both feed the same bad habit, replacing hard statistical reasoning with compelling but empty narratives. What's worse is that this doesn't just happen in retail finance or the media. It happens at the institutional level too. Investment communities, hedge fund strategies, central bank forecasts, and financial journalism. This section covers how these illusions operate and why statistical reasoning is very hard to do in finance. The illusion of understanding is simple. People believe they understand what's going on even when they clearly don't. In finance, this shows up constantly. People tell stories about why a stock moved, why currency broke trend, why an earnings report disappointed after the fact. Everything is explained, but it wasn't predicted. And the same story would not have been accepted had the outcome been different. That's the hallmark of this illusion, ex post coherence. Once an event occurs, the brain retrofits a story to make it make sense. For example, the market drops 3% in a day. One outlet says that it's because of rate hike fears. Another is that it's because of earnings concerns. The other blames geopolitical tension. They're just attaching post hoc effects to the causes. What's dangerous is how quickly the illusion becomes internalized. People start to believe their own explanations. This isn't about lying, it's about self-deception. Investors believe they understand the causal structure of a system that is in reality partially or mostly random. The illusion of understanding is comfortable. It creates the feeling of control, it gives confidence, but it's false. And in finance, false confidence is of course very expensive. More dangerously, this illusion can turn bad ideas into consensus. Once a causal story takes hold, even if it's weak, it can anchor beliefs, shape forecasts, and justify allocation decisions that seem overconfident. At scale, this illusion creates a lot of mispricings. This is why you see a lot of differences between intrinsic and reported value, because it's not driven by data or by shared fiction. Remember the old Graham or Buffett quote that in the short term, the stock game is a voting machine, but in the long term, it's a weighing machine. If the illusion of understanding is about feeling like you understand something but when you don't, the illusion of validity is about feeling like your judgment is accurate even when it isn't. In simple terms, we overrate our ability to predict outcomes based on flimsy evidence. We see a pattern, trust it, and act as it's valid without checking whether the data supports it. Kahneman illustrated this with a classic example. Military psychologists evaluating officer candidates based on brief field exercises. The psychologists felt confident in their ratings. They were observing behavior, making assessments, and drawing conclusions. But when they checked their ratings against actual military performance, when you send these cadets out into the real world, there was no correlation. Their judgments felt valid until they aren't. This happens constantly in financial markets. A fund manager identifies a macro pattern, say bond rallies after every third Fed interest rate hike, and bets the fund on it. The pattern is shaky at best, but it feels real. What is common in all these cases is this. The evidence feels that it should be predictive, so we treat it as if it is, even when it's not. This illusion is strengthened by consistency. The more coherent a story or model seems, the more valid it feels, even when it has no predictive power. Humans confuse internal logic with external accuracy. Worse, the more experience someone has, the more susceptible they can be to this. Professionals are trained to recognize patterns implicitly, but unless those patterns are statistically verified across enough data and tested for randomness, they're just stories with charts. And actually, experience makes someone worse because they start tracking patterns that don't exist. The illusion of validity feeds overconfidence. It leads people to bet too much, extrapolate too far from data that should not be conclusive, and trust their intuition over hard evidence. In markets, this shows up in concentrated trades, especially when funds bet way too much of their capital on a single stock based on just gut feel, and they also reject contradictory data that might say that certain trades are a bad idea. And now this is where both illusions converge. When people are given a choice between a compelling causal story and a statistical base rate, they almost always choose the story. Even when they have been shown that the statistics are more predictive, they still go with the cause. This isn't just ignorance, it's psychological and how we function as humans. System 1 favors coherence. It wants things to make sense. A good story engages memory, emotion, and imagination. A base rate is sterile. It feels impersonal and inapplicable even when it's accurate. This distorts decision making constantly, especially in finance. For example, suppose a stock has a 70% chance of underperforming based on its financial profile, debt load, and sector conditions. Basically, we ran a financial statement analysis on a specific stock. But then a charismatic CEO takes over. Analysts start talking about vision, turnaround strategy, and synergy. The story overrides the sudden base rate. The stock is re-rated upwards, not because the statistical odds have changed, but because the story got better. This is not a rare event. This is the norm in how most firms actually value certain stocks. You see the same thing in fund allocation. A manager might have a mediocre track record, but if the narrative around their strategy sounds sophisticated, for example, they put in machine learning, market neutral, ESG integration, allocators treat this as evidence of competence. They favor the cause over the data. In IPOs, in macro forecasts, in sector rotations, the pattern sort of repeats itself. Numbers get ignored when the cause is available. Even when people are known to be shown base rate data along with the cause, they downgrade its importance. And they do believe that each situation is unique, that this time it will be different, that the general base rate rule of a 50% chance of failing or 90% chance of failing doesn't really apply to that specific case. However, we intuitively know that base rates are better than stories. Our system 2 brains, especially when adjusted, typically look out for base rates first over stories. This is why people don't trust anecdotes, avoiding explanation until the data justifies for it, and actually looking for negative evidence or evidence that might contradict our original stance so that we can know that something is true. But this is hard. The industry rewards good stories, especially in journalism, in financial journalism. Clients prefer causes, media thrives on explanations, and everyone wants to know why. Saying we don't know or we are unsure or it could be this or this isn't rewarded even if it's actually the most correct answer. That's why this bias persists, and that's why Kahneman's insight matters.